Hashtag Chapter 1. General Insurance. Inside Chapter QA. Insurance company is owned by its policyholders. A. Reciprocal. B. Fraternal Benefits Society. C. Stock. D. Answer. Mutual. Definition. Its members, also called policyholders, own a mutual insurance company. If an insurance company wants to transfer all or part of the risk it has accepted, it would buy which of the following types of insurance? A. Insurer. B. Reciprocal. C. Residual. D. Answer. Reinsurance. Definition. An insurance company that accepts a portion of a risk for an insurance company is called a reinsurance company. Which of the following is an insurance company that is organized under the laws of a different state within the United States? A. Alien. B. Domestic. C. Authorized. D. Answer. Foreign. Definition. A foreign insurer is not organized under the laws of the state in which it is writing insurance, whereas a domestic insurer is organized under the laws of the state in which it is writing insurance. Which insurance company department accepts the insurance risk? A. Actuarial. B. Executive. C. Claim. D. Answer. Underwriting. Definition. The underwriting department is responsible for evaluating the acceptability of a risk and, once accepted, determines the actual rate to be charged. Which of the following authorities does the public assume an agent has based on the agent's conduct? A. Express. B. Implied. C. Authorized. D. Answer. Apparent. Definition. Apparent authority is demonstrated when the principal's conduct gives the general appearance that the authority exists. A person with a legal or ethical relationship of trust with another party is A. Adjuster. B. Principal. C. Beneficiary. D. Answer. Fiduciary. Definition. A fiduciary has a legal or ethical relationship of trust with another party, prudently taking care of money that party's money. A producer has each of the following responsibilities to the insurer, except A. Reporting material facts that may affect underwriting. B. Forwarding premiums to the insurer on a timely basis. C. A fiduciary duty. D. Answer. A duty to recommend only high premium policies. Definition. The producer is responsible to the insurance applicant to promptly forward premiums to the insurer, recommend the best protection, gain knowledge of the applicant's insurance needs and current insurance coverage, and serve the applicant's best interests. To engage or participate in the insurance business, a prohibited person must first apply for A. Insurance consultant's license. B. Waiver of felony conviction. C. Producer's license. D. Answer. 1033 waiver for consent to work. Definition. A prohibited person that has been convicted of a felony must first apply for a 1033 waiver for consent to work from the appropriate insurance commissioner. Dishonest tendencies that increase the probability of loss are what types of hazard? A. Emotional. B. Legal. C. Physical. D. Answer. Moral. Definition. A hazard increases the chance of loss, and the three types are moral, morale, which is indifference or carelessness, and physical, which is a physical condition. Each of the following must be included in an insurable risk, except A. Calculable chance of loss. B. Accidental losses. C. Excluded catastrophic perils. D. Answer. Large group with different risks. Definition. An insurable risk must also include a large number of groups with the same perils, affordable premiums, and the loss must be measurable. Which principle of insurance restores the insured to the same economic condition that existed before the loss? A. Adhesion. B. Insurability. C. Underwriting. D. Answer. Indemnity. Definition. An insured should not profit from an insurance loss. Each of the following is an element of a legal contract, except A. Agreement. B. Legal purpose. C. Consideration. D. Answer. Indemnity. Definition. The fourth element of a legal contract is a competent party or someone that has the legal capacity to enter into a legal contract. A warranty is defined as which of the following? A. What a reasonable and prudent buyer can expect. B. Intentional misrepresentation on the application. C. A false statement in the application. D. Answer. Statement in the application that is guaranteed to be true. Definition. A warranty is a statement guaranteed true in all respects, and if later discovered to be false, the contract may be voided. Each of the following is a factor considered by an underwriter except A. Gender. B. Hazardous occupation. C. Age. D. Answer. Marital status. Definition. Marital status is not an underwriting factor, but the nature of the risk is also considered. End of chapter QA. Which branch of the state government is responsible for enforcing the existing statutes that have been put in place? A. Judicial. B. Electoral. C. Legislative. D. Answer. Executive. Definition. The state's executive branch enforces the existing statutes that have been put in place. 2. A company that is licensed to sell insurance in a particular state is A. A foreign company. B. A non-admitted company. C. A domiciled company. D. Answer. An authorized company. Definition. An authorized company is one that is licensed to sell insurance in a particular state. It is also considered to be an admitted company. 3. Producers have a duty to only recommend coverage based on what is suitable. A. To the insurer. B. To both the insured and the insurer. C. To the beneficiary. D. Answer. To the consumer. Definition. Producers have a duty to only recommend coverage based on what is suitable to the consumer, not what would be most profitable for the producer or for any insurer for whom they act as agents. 4. Of London consists of groups of underwriters specializing in insuring particular risk types. What are these underwriting groups called? A. Lloyd's. B. Members. C. Lead underwriters. D. Answer. Syndicates. Definition. Lloyd's of London is not an insurance company, but consists of groups of underwriters called syndicates, each specializing in insuring a particular type of risk. 5. An insurer that has not received permission from an insurance commissioner to do business in their state is called A.N. A. Domestic insurer. B. Admitted insurer. C. Mutual insurer. D. Answer. Non-admitted insurer. Definition. When an insurance commissioner refuses to admit an insurer to sell life insurance in the state, the insurer is unauthorized or non-admitted. 6. Selecting acceptable risks is the primary responsibility of the A. Producer. B. Actuary. C. Adjuster. D. Answer. Underwriter. Domestic insurer. Definition. The selection of risk is the primary responsibility of the underwriter. The underwriter protects the insurer by selecting risks in the normal range of expected losses. 7. Which of the following is an accurate definition of pure risk? A. A chance of gain only. B. A chance of loss or gain exists. C. A chance of gain. No chance of loss. D. Answer. A chance of loss or no loss, but no chance of gain. Definition. Pure risk is a scenario where there is no possibility of gain. Either a loss will happen or nothing will happen. 8. An insurance company selling part of their risk to another insurance company is called A. Other insurance. B. Risk retention. C. Hold harmless agreement. D. Answer. Reinsurance. Definition. Reinsurance is how insurance companies share their risk, particularly larger risks. An insurer retains part of the risk and cedes the remaining risk to one or more insurers with a reinsurance agreement. 9. Which of the following terms indicates a legal and ethical relationship of trust regarding another party's money? A. Professionalism. B. Consumer rights. C. Law of agency. D. Answer. Fiduciary duty. Definition. Producers have a fiduciary duty to the insurer. For example, they are responsible for submitting collected premiums in a timely manner. 10. Statements made on the application by the applicant that are believed to be true to the best of the applicant's knowledge are called A. Waivers. B. Warranties. C. Conditions. D. ASMR. Representations. Definition. Statements made on the application by the applicant are known as representations. Representations are believed to be true to the best of the applicant's knowledge. Warranties are statements that are guaranteed to be true. Hashtag Chapter 2. Life Basics. Inside Chapter QA. J is named in a policy as the individual who is entitled to receive the policy proceeds upon the death of T. Which of the following statements best applies to this scenario? A. T is the owner and beneficiary of the policy. B. J is named as the owner of T's policy. C. J is the insured and beneficiary of the policy. D. Answer. T is the insured in the policy and J is the named beneficiary. Definition. Based on the information provided, it can only be determined that T is the insured and J is the beneficiary. A life insurance policy is being applied for on Z's life. In order for the contract to be valid, all of the following have an insurable interest and could be the owner of the policy except A. Z's business partner. B. Z's spouse. C. Z. D. Answer. Z's neighbor. Definition. The insured's neighbor does not have insurable interest. A general description of the basic types of life insurance used to assist prospective purchasers can be found in the A. Illustration. B. Cost Comparison Index. C. Policy Summary. D. Answer. Buyer's Guide. Definition. A buyer's guide provides general information used to assist prospective buyers of life insurance. It includes a description of the basic types of life insurance, how to choose a policy, and the comparative costs of each policy. Which of the following is not required to sign a completed application? A. Producer. B. Applicant. C. Insured or guardian. D. Answer. Beneficiary. Definition. The applicant, insured, or guardian if a minor, and the producer's signatures are all required in an application for insurance. The beneficiary is not required to sign the application. An applicant for life insurance realizes several days after completing the application that she may have answered a medical question incorrectly. She should do which of the following? A. Hope that nothing happens in the first year after the policy is issued, because after that it won't matter if the answer was or wasn't correct. B. Wait to find out if she is approved for the insurance first, and then she can let the company know she may have made a mistake. C. Nothing. Answers in the application must only be true to the best of her knowledge at the time she submits the application. D. Answer. Contact either her agent or the insurance company and make sure they have the correct information. Definition. The insurance company is entitled to have the most correct information available before it approves a person for insurance. Incorrect information in the application may only be changed before the policy is issued. Information from a third party collected by the insurance company in the application for insurance and during underwriting of the policy may be subject to the jurisdiction of the A. Fair Claims Reporting Act. B. Deceptive Trade Practices Act. C. Unfair Claims Practices Act. D. Answer. Fair Credit Reporting Act. Definition. The Fair Credit Reporting Act is the only one in the list which may have jurisdiction over information gathered for underwriting purposes. Which of the following is not true about life insurance applications? A. The application more fully identifies the insured. B. The application may contain all the information underwriting needs to approve the insured. C. Applications for life insurance are typically divided into two parts, general information and health history. D. Answer. The application is confidential communication between the agent and the insurer. Definition. A copy of the application will be included as part of the policy and is therefore not confidential. Which of the following statements correctly describes the difference between gross premium and net premium? A. Net premium is the total paid to the insurance company each month. Gross premium is described in terms of the number of dollars per $1,000 a person pays for her insurance. B. The net premium is the cost per $1,000 of insurance. The gross premium excludes insurance company expenses. C. Gross premium is what the insured pays to the insurance company each month. Net premium is what the agent's commission is based on. D. Answer. Gross premium is the total amount paid for the policy. Net premium does not include the insurance company's cost of doing business, such as paying commissions and other expenses. Definition. Gross premium is the total amount a person pays the insurer for her coverage. Net premium, sometimes called the pure premium, does not include business expenses of the insurer. Which of these modes would result in the insured paying the least amount per year for life insurance? A. Semi-annual payroll deduction. B. Quarterly. C. Monthly automatic bank draft. D. Answer. Annual. Definition. Paying premiums on an annual basis is always the least costly premium mode. Paying premiums monthly is usually the most expensive mode. Which of the following is a personal use of life insurance? A. Compensating a business for the death of a key person. B. Providing protection against living too long. C. Creating an insurable interest. D. Answer. Creating an immediate estate. Definition. Life insurance proceeds paid in a lump sum provide financial assets to create an immediate estate for the named beneficiary. When determining an appropriate amount of life insurance, a producer takes into consideration the existing mortgage and other debt, future education expenses for the client's children, and continuing income for the surviving spouse. This approach is known as A. The DIME method of insurance planning. B. The NAC model. C. Human life value. D. Answer. Needs analysis. Definition. When a producer takes into account a variety of factors related to lost future income, they are using a needs approach. Which of the following describes group life insurance? A. A single policy issued to a group of individuals who have formed an alliance to obtain life insurance at reduced rates. B. A single policy issued to an individual covering husband, wife, and children. C. Multiple policies issued to an employer to cover a specific group of executives. D. Answer. A single policy issued to a business to cover the lives of employees. Definition. Group insurance is underwritten as a single policy that covers many lives. A policy issued to an individual that covers all family members is still an individual policy. A group specifically formed for the purpose of obtaining insurance is not a valid group under state insurance laws. End of chapter QA. Which of the following activities could be considered stranger/investor originated life insurance? A. Filling out the application for life insurance on behalf of the insured. B. Purchasing life insurance for a dependent child. C. Filing a claim as the designated beneficiary after the insured dies. D. Answer. Changing the policy ownership and beneficiary designations. Definition. After the investors have paid for the policy, they will change the ownership and beneficiary designations. The investors will also have to pay premiums to keep the policy in force. The investors will file a claim for the death benefit upon the insured's death. In order for a life insurance policy to be valid, insurable interest must exist at time of A. Conversion. B. Claim. C. Issuance change to expiration. D. Answer. Application. Definition. For a life insurance policy to be valid, insurable interest need only exist at the time of application when the policy is issued. Industrial life insurance is also referred to as A. Group life insurance. B. Participating life insurance. C. Non-participating life insurance. D. Answer. Home service life insurance. Definition. Industrial or home service life insurance is individual life insurance written for $1,000 or less to provide for burial coverage. Part 2 of a life insurance application consists of all of the following information except A. Surgeries. B. Hospitalizations. Coverage. C. Past and present health. D. Answer. Date of birth and gender. Definition. Part 2 of the application contains questions pertaining to medical background, past and present health, any medical visits, hospitalizations, or surgeries in recent years, medical status of immediate family members, and age and causes of their death. Which of the following signatures would not be considered valid on an application for insurance? A. A guardian applicant. B. The licensed producer. C. The policy owner. D. Answer. A minor insured. Definition. Both the producer or agent and the applicant/insured must sign the application unless the guardian is signing for a minor. When planning for the income of a surviving spouse, capital liquidation is used to meet the survivor's income objectives by A. Paying out policy proceeds and reinvesting earnings. B. Paying out policy proceeds. C. Paying out interest earned. D. Answer. Paying out all policy proceeds and interest earned. Definition. In capital liquidation strategy, policy proceeds and earnings are paid out over the anticipated period to meet the income objective. Each payment would be the same as any investment earning shortfall, which principal liquidations would offset. A. Is usually treated as an insurance company liability. A. Dividend. B. Gross premium. C. Net premium. D. Answer. Reserve. Utilizations. Definition. A reserve is an amount representing actual or potential liabilities kept by an insurer to cover debts to policyholders. A reserve is usually treated as a liability. Which of the following types of life policies is eligible for policy dividends? A. Fixed. B. Non-participating. C. Variable. D. Answer. Participating. Without interest earned. Definition. Participating life policies are issued by mutual companies and are eligible for policy dividends if and when declared by the company's board of directors. Which of the following products provides an immediate lump sum in the event of premature death? A. Annuity. B. Social Security. C. Disability insurance. D. Answer. Licensed producer. Life insurance. Definition. Of these options, only life insurance provides an immediate lump sum upon death. Which type of insurance covers the liability of a producer or agency? A. Inadequacy and negligence. B. Property and casualty. C. Complaint protection. D. Answer. Errors and omissions. Definition. Errors and omissions insurance covers producers and agencies to protect them against complaints alleging inadequacy or negligence in carrying out their professional responsibilities. Hashtag Chapter 3. Types of policies and riders. Inside Chapter QA. When a whole life policy endows, what happens to the policy's cash value? A. Cash value is only found in term life policies, not whole life. B. The cash value reverts to the insurance company. C. The cash value is deducted from the death benefit and the remainder is paid to the policy owner. D. Answer. The cash value equals the face amount, and the face amount is paid to the policy owner. Definition. At endowment, because the insured has not already died, a whole life policy's cash value will equal the face amount of insurance. The policy ends and the cash value is paid to the policy owner. The face amount of insurance is also referred to as the maximum loan value. B. The cash surrender value. C. The cash value. D. Answer. The limit of liability. Definition. The face amount of insurance is the stated death benefit and is referred to as the insurer's limit of liability, the most the policy will pay in the event of the insured's death. Which of the following is not a feature of term life insurance? A. Level premium. B. Pure protection. C. Temporary coverage. D. Answer. Cash value guarantees. Definition. Term life insurance has no cash value. It does have a level premium, temporary coverage, and is often referred to as providing pure protection. A level term policy means that the remains the same throughout the lifetime of the policy. A. Policy owner. B. Pure cost of insurance. C. Cash value. D. Answer. Policy proceeds. Definati 9 on. The policy proceeds are also known as the death benefit or face amount. The name of the policy, level, decreasing, or increasing term, specifies what happens to the face amount or policy proceeds. A level term policy means that the policy proceeds remain the same throughout the lifetime of the policy. A producer is explaining the concept of limited pay life insurance to her client. Which of these statements is incorrect? A. A policy fully paid up at age 65 will not endow until age 100. B. Paying over a longer period of time will make the total payments higher. C. By paying over a shorter period of time, each of the payments will be higher. D. Answer. By paying over a shorter period of time, each of the payments will be lower. Definition. The basic concept of insurance premiums is that by paying less often, a person will pay less in total premium. However, in cash value policies, because the payments are funding the cash value, the actual amount per payment in a limited payment policy will be higher as the number of payments is reduced. A 10-pay policy will have higher premiums than a 20-pay policy, but the total of the 10 payments will be much less than the total of the 20 payments. Which of the following are characteristics of universal life insurance policies? A. Adjustable death benefit. Premiums are fixed for life. B. Fixed death benefit for life. Premiums may be increased or decreased. C. Death benefit options. Premiums fixed for life. D. Answer. Death benefit options, death benefit, and premiums may be changed. Definition. Death benefits options are a key characteristic of all forms of universal life insurance. All UL policies permit the policy owner to make changes in both the amount and timing of premium payments, including making no payments at all, and the death benefit may be increased or decreased in accordance with the terms and provisions of the policy. Policy has a death benefit that can increase or decrease over time based on stock market performance, a guaranteed minimum death benefit, a choice of sub-accounts in which cash value may be allocated, and a fixed premium. A. Equity indexed universal life. B. Investment grade whole life. C. Variable universal life. D. Answer. Variable life. Definition. Only variable life, also known as variable whole life, has all of these characteristics. Variable universal life does not adjust the death benefit in relation to stock market performance. Equity indexed universal life does not permit allocation of cash value in stock-based funds. There is no such thing as investment grade whole life. What jumps in a jumping juvenile policy? 8. The premium and the face amount jump by a factor of 5 after the child's 21st or 25th birthday. B. The premium increases by a factor of 5 on the child's 21st or 25th birthday. C. The premium jumps 5 times over the life of the policy, beginning at age 21 or 25. D. Answer. The face amount jumps 1 time, usually to 5 times the amount of insurance, at age 21 or 25. Definition. A jumping juvenile policy will normally increase the face amount of insurance by a factor of 5 with no change in premium at the next anniversary after the child turns anywhere from age 21 to 25. Depends on the policy. Ownership of the policy also changes at that time to the child, who is now an adult. A last to die policy would be the most appropriate recommendation for which of the following? A. A corporation concerned that its CEO might die before the end of his employment contract. B. 2 business partners who are concerned about the future success of the business and want to provide funds to purchase the business from the decedent's family. C. A business owner who wants to make sure his wife has enough money to buy the business from his partner if he dies before his partner does. D. Answer. A husband and wife concerned about paying estate taxes after they have died. Definition. Married couples worried about estate taxes would be best served in most cases by a last to die or survivorship policy. Which of these best describes a disability income rider? A. Automatically creates an unlimited loan fund in the amount of the death benefit, secured by the cash value when an insured is totally disabled. B. pays a percentage of the annual premiums as monthly income to the insured if they are totally disabled. C. Pays a percentage of the death benefit as monthly income to the insured when totally disabled. D. Answer. Provides for double the face amount if the insured is disabled and has no income. Definition. A disability income rider pays monthly income to a totally disabled insured. The income is a specified number of dollars per $1,000 of death benefit, which may be expressed as a percentage of the death benefit. Waiver of premium allows the insured to avoid paying premiums when totally disabled. Money paid as income under a disability income rider does not affect the death benefit in any way. What does a long-term care rider offer that a living needs rider does not? A. Provides money equal to a portion of the death benefit to an insured expected to die in the next 2 years. B. Pays a percentage of the death benefit as monthly income for an insured who cannot perform any one of the 6 activities of daily living. C. Establishes a trust fund for the insured's family so that home health care can be paid for with insurance premiums instead of paying the money to the life insurance company. D. Answer. Provides up to 100% of the death benefit in a daily or monthly amount for the non-hospital expenses of a chronically ill person who cannot perform any 2 of the 6 activities of daily living. Definition. A long-term care rider provides an advance payment of the death benefit for the covered expenses of long-term care a chronically ill person may incur. A viatical settlement is made between the purchaser of a person's life insurance policy and A. The lender who owns the mortgage on the terminally ill insured's home or business property. B. The agent representing the family of the terminally ill insured. C. The terminally ill insured person's spouse and children who don't want to wait until the insured dies to collect the death benefit. D. Answer. The terminally ill insured who must receive at least as much as would be available from the insurance company under any full cash surrender or living needs rider. Definition. The viatical life settlement laws, which have been adopted by the states, are intended to protect a terminally ill person from exploitation. They must not obtain a lesser benefit than they could obtain on their own by taking a loan or cash surrender from their life insurance company or through a living needs provision or rider in their policy. End of chapter QA. Variable whole life and variable universal life are similar except for A. The licensing and registration required to sell them. B. The offering document required to be presented to the client prior to purchase. C. The investment risk is held by the policy owner. D. Answer. The guaranteed death benefit. Definition. Since all premiums are credited to a separate account, there is no guaranteed minimum death benefit in a variable universal life policy. Policy loans are available from the general or separate accounts for variable policies. What percentage of the cash value can typically be borrowed against a variable policy? A. 5% annually. B. 55 to 70%. C. 35 to 50%. D. Answer. 75 to 90%. Definition. Policy loans are available from either the general account or the separate account. Typically 75 to 90% of the cash value can be borrowed against. Partial surrenders are not allowed from a variable whole life policy. A 22-year-old applicant for life insurance has a limited budget for premiums. Which of the following policies would provide the highest face value for the lowest annual premium? A. 20-year term. B. 10-year term. C. 30-year term. D. Answer. Licensed producer. Annually renewable term. Definition. The shortest term period offers the lowest cost per $1,000 of coverage at the outset and early years. One of the greatest advantages of convertible and renewable term policies is that A. The insured is guaranteed the right to renew or convert at any age with no increase in premium. B. They always renew or convert at the insured's original issue age. C. They provide living benefits. D. Answer. The insured is not required to show proof of insurability in order to renew or convert. Definition. Both convertible and renewable term policies allow the insured to get new insurance at their attained age when the original term of coverage has expired without proving insurability. The number of years excluded from the conversion period on a convertible term policy. A is 10 years. B is 15 years. C is 8 years. D, answer, is established in the policy contract and varies. Definition: insurance companies establish the conversion periods on term policies and can vary from one company to the next. In a viatical settlement transaction, the life insurance policy owner is referred to as the A, viatee, B, third party, C, provider, D, answer, licensed producer. Viator. Definition: in a viatical settlement, the life insurance policy owner is referred to as a viator. Which of the following policies initially begins with a lower premium and then increases to remain level through the policy's life? A, variable life. B, universal life. C, graded premium whole life. D, answer, modified premium whole life. Definition: modified premium whole life insurance premiums do not remain level. A modified premium policy begins with a lower premium than an ordinary whole life for the initial 5 years. After 5 years, the premium will increase and remain level throughout the balance of the policy's life. Which of the following types of term life insurance can be written as a rider to provide cost of living or return of premium benefits? A, level term. B, decreasing term. C, annual renewable term. D, answer, increasing term. Definition: increasing term can be issued as a rider on a policy to provide cost of living or return of premium benefits. The purpose of the reentry term option is to A, extend the length of time the original policy can be in effect. B, obtain a permanent plan of insurance that builds cash value. C, continue on with the existing policy, but with a larger face amount. D, answer, licensed producer. Obtain a new term policy at a lower rate. Definition: the main purpose of a reentry term option is to allow a healthy insured to acquire a new term life insurance policy at a rate lower than what is currently being charged on the existing policy. In a universal life policy, the minimum separation between the cash value and the death benefit is called the A, cash value. B, MEC limit. C, interest. D, answer, risk corridor. Definition: a universal life insurance policy must always have an amount at risk. When the cash value of the policy comes close to the face amount, the death benefit must increase to cover this amount at risk. This minimum difference between the cash value and the death benefit is known as the risk corridor. Hashtag Chapter 4. Life Policy Provisions and Options. Inside Chapter QA. The insuring agreement in a life insurance policy states which of the following? A, the insurance company will not pay death claims in the event of suicide or other exclusion named in the policy unless all premiums are paid in advance. B, the policy owner will indemnify the insurance company of the policy proceeds if the beneficiary is not named in the application. C, the insurance company may refuse to pay a death claim in the event a mistake is found in the original application for insurance at the time of the insured's death. D, answer, the obligation of the insurance company to pay the policy proceeds upon presentation of valid proof of the death of the insured which occurred while the policy is in force. Definition: the insuring agreement is the basic promise to pay the benefit described in the policy when a claim is proved. In life insurance, a true certified copy of the death certificate is valid proof of death. What is meant when a life insurance policy becomes incontestable? A, after 2 years, the insurer will only pay for suicide if the insured was insane at the time of death. B, after 2 years, the insurer will not argue about which beneficiary is primary or contingent. C, after 2 years, the policy owner cannot sue the insurer for misstatements made by the producer in the sale of the policy. D, answer, after 2 years, the insurer will not refuse to pay a death claim based on misinformation in the original application for insurance. Definition: incontestability means that the insurance company cannot use the statements in the original application for insurance as a reason to avoid paying a death claim. The policy becomes incontestable after 2 years in most states. The grace period in a life insurance policy is typically 31 days and provides for A. The payment of the premium after the due date with a maximum 5% penalty. B. The policy owner to reinstate the policy before it lapses. C. The insurance company to delay payment of the death benefit while it determines the validity of the proof of death. D. Answer. The payment of the premium after the due date without a penalty or lapse in coverage. The grace period allows payment of the past due premium without a penalty or lapse in coverage. Any claim arising in the grace period is payable, but any unpaid premium will be deducted from the claim when paid. What is the primary advantage to the policy owner in the reinstatement of a life insurance policy? A. The insured is not required to prove insurability if under age 40. B. The insurance company cannot start a new period of contestability. C. All policy loans that were outstanding at the time of lapse are forgiven and full cash value is restored. D. Answer. The policy owner continues to enjoy the benefits that were provided in the original policy, including the original premium. Definition: reinstatement restores the policy to its original condition as if it were never lapsed. Even though the policy is reinstated at a later age, the original issue premium is all that the insurer will require. Policy loan provisions include all of the following except A. Outstanding loans will be deducted from the face amount at time of claim. B. Interest is charged annually. C. Unpaid interest is added to the value of the loan. D. Answer. The death benefit of a policy is automatically reduced when a loan is requested. Definition: policy loans do not automatically reduce the death benefit in a policy. If an outstanding loan exists at the time of death, the amount of the loan will then reduce the benefit paid to the beneficiary. A contingent beneficiary has the right to which of the following? A. Share in the death benefit with the primary beneficiary. B. The policy proceeds if the primary beneficiary is a minor child. C. Prevent the policy owner from taking a loan against the cash value. D. Answer. The policy proceeds only when there is no primary beneficiary. Definition: a contingent beneficiary has no interest in the policy proceeds if there is a surviving primary beneficiary. Contingent and primary beneficiaries do not share the death benefit. Only an irrevocable primary beneficiary has the right to interfere with certain of the owner's rights in a life insurance policy. Which of the following is a reason why class designations of beneficiaries may be a problem? A. They specify the exact persons who may claim policy proceeds. B. They prevent contingent beneficiaries from being named. C. They're intended to allow unnamed persons to share policy proceeds. D. Answer. They are vague descriptions of beneficiaries that could result in a court having to decide which persons will or will not receive the policy proceeds. Definition: class designations of beneficiaries are intended to provide benefits to a number of unnamed persons, but can be problematic when there is insufficient understanding about who is being named as a beneficiary. All My Children does not clearly identify which children are included: the children of a former marriage, the current marriage, or both. Likewise, My Minor Children disregards the fact that children will eventually become adults and can unintentionally exclude a child as a result. The spendthrift laws of each state protect life insurance proceeds against the claims of which of the following? A. Primary beneficiaries only. B. Contingent beneficiaries only. C. Creditors of the insured only. D. Answer. Creditors of any beneficiary. Definition: spendthrift laws prevent creditors of any beneficiary from claiming any benefits payable to the beneficiary before they are actually received. Interest only, life income with refund, lump sum, and life income only are all forms of which of these life insurance policy options? A. Non-forfeiture options. B. Dividend options. C. Beneficiary options. D. Answer. Settlement options. Definition: these are all forms of settlement options, how the beneficiary will receive the policy proceeds. Non-forfeiture options are concerned with cash value. Dividend options do not include which of the following choices? A. Refund in cash. B. Reduce premiums due. C. Paid up additional insurance. D. Answer. Lifetime income. Definition. Income for life is an annuity form of death benefit settlement option. Hashtag end of chapter QA. Unlike riders, life insurance provisions and clauses are included in the contract for A. A slight fee. B. A nominal charge. C. A premium. D. Answer. No additional charge. Definition. Provisions and clauses do not require an additional charge, as they provide essential clarification regarding how coverage applies and the duties of the parties to the contract. Riders, on the other hand, often provide more coverage than the standard policy, meaning they often come with an additional charge. The time period provided after the premium due date before a life insurance policy lapses is known as the A. Reinstatement period. B. Free look period. C. Automatic premium loan period. D. Answer. Grace period. Definition. The grace period is the time period provided after the premium due date before a policy lapses. The surrender charge schedule for a variable universal life policy generally does which of the following over time? A. Increase. B. Remain the same. C. Fluctuate. D. Answer. Decrease. Definition. Over time, the surrender charge schedule decreases to 0%, generally after 10 to 20 years after policy issuance. If the beneficiary is concerned about a payout for a particular period of time, the settlement option should be selected. A. Joint and survivor. B. Life with period certain. C. Fixed amount. D. Answer. Fixed period. Definition. Fixed period payments are guaranteed for a specified period of time, such as 10 or 20 years, after which time payments will cease. The proceeds and interest are used to make the payments. The cash received by the policy owner when they terminate a life insurance policy is known as A. Paid up insurance value. B. Accrued premium value. C. Loan value. D. Answer. Cash surrender value. Definition. The cash surrender value is the amount a policy owner is entitled to when a policy is terminated. It equals the cash value minus any applicable surrender charge. If overdue premiums are not paid by the end of the grace period, a traditional whole life policy will automatically A. Be reduced in face amount by the amount of the overdue premium. B. Be canceled with no value. C. Be cash surrendered. D. Answer. Become extended term. Definition. The automatic option at the end of the grace period for a traditional whole life policy is the extended term non-forfeiture option. This will keep the original face amount in place for a certain number of years and days as indicated on the table inside the policy. Which statement is false regarding non-forfeiture options? A. They protect the policy owner against total loss of benefits if the policy should lapse or be canceled. B. They add flexibility to a cash value policy. C. The three non-forfeiture options are cash surrender, reduced paid up, and extended term. D. Answer. They are used when the insured lives to the endowment date of the policy or at the insured's death. Definition. Distribution options used when the insured lives to the endowment date of the policy or at the insured's death are settlement options, not non-forfeiture options. J is the insured and their spouse. M is the primary beneficiary. Their 3 children are the contingent beneficiaries. J and M are killed in a common accident. The proceeds of J's policy would be paid to A. J's estate. B. M's estate. C. J's parents. D. Answer. The children. Definition. Contingent beneficiaries receive the policy proceeds in the absence of the primary beneficiary. The Common Disaster Clause assumes the primary beneficiary died before the insured if both are killed in the same accident. What life insurance provision establishes that if both the insured and the primary beneficiary die in the same accident and it cannot be determined who died first, the insured will be presumed to have survived the beneficiary, and proceeds will be paid to a named contingent beneficiary of the insured or to the insured's estate. A. Insuring clause. B. Spendthrift clause. C. Consideration clause. D. Answer. Common disaster clause. Definition. The common disaster clause is designed to rule in these circumstances. If a contingent beneficiary is named and is alive, they receive the proceeds. Otherwise, the funds are paid to the insured's estate. Assignment in life insurance is the act of A. Completing an insurance application for a life insurance policy. B. Selecting options and riders during the application process for a life insurance policy. C. Submitting the application for underwriting. D. Answer. Transferring all or part of the ownership in a life insurance policy. Definition. Assignment is the transfer of all or part of the ownership of a life insurance policy. Hashtag Chapter 5. Annuities. Inside Chapter QA. A contract that is designed to accumulate value over time with the intent to distribute the funds over the lifetime of an individual is called A. Variable life insurance. B. An endowment. C. Whole life insurance. D. Answer. An annuity. Definition. Annuities are designed to liquidate accumulated assets rather than to create a sum of money as a direct benefit for another person. When an annuity is not already annuitized, it is subject to state insurance non-forfeiture laws, and the contract value must be paid to a beneficiary, to the owner, or to the owner's estate following the death of the annuitant. While life insurance may accumulate money that a person could use in retirement, none promise the same long-term benefit of a non-qualified annuity, which is A. Tax-free money for college education or other qualified expenses. B. Tax-free payments for the lifetime of a beneficiary. C. Tax-deferred growth of principal. D. Answer. A stream of income the annuitant cannot outlive. Definition. Although both annuities and life insurance offer tax-deferred growth of principal, the long-term benefit of an annuity is the lifetime income stream available at any time to the annuitant. When the owner and annuitant is the same person, a spouse beneficiary is permitted what choice under the Internal Revenue Code if the annuitant dies prior to annuitizing the contract? A. A one-time opportunity to convert the proceeds to a Roth IRA without taxation. B. There are no choices. When the annuitant dies, the principal value must be distributed to the beneficiary, who may choose the distribution option if none was selected in advance. C. The option to withdraw all funds tax-free in the form of a Section 1035 exchange to life insurance. D. Answer. To adopt the annuity as her own and become the annuitant, or to name another annuitant. Definition. The spouse beneficiary may adopt the annuity as her own. As the owner, she may name a new annuitant and/or beneficiary, or assign ownership to another person for value. All of the following are correct regarding an annuity except A. An annuity can be immediate or deferred. B. An annuity can be paid with a single premium or periodic premium. C. The accumulation in an annuity grows tax-deferred. D. Answer. An immediate annuity must start providing income within 3 years of the first premium payment. Definition. An immediate annuity must start providing income within a year of the first premium payment. A flexible premium deferred annuity permits all of the following except A. Limited partial surrenders each year not subject to a surrender charge. B. Annuitization at any time after 1 year. C. Scheduled and unscheduled additions of principal at any time prior to annuitization. D. Answer. Payments to the annuitant beginning within 1 month of the issuance of the contract. Definition. By definition, a flexible premium annuity allows the addition of more principal value at any time prior to annuitization of the contract. If an annuity begins payments to the annuitant within 1 month of policy issue, it would be a single premium immediate annuity, SPA. Which of these annuity distribution options promises the largest possible payment to a single annuitant? A. Installment refund. B. Life income with period certain. C. Lump sum refund. D. Answer. Pure life. Definition. because the insurance company has no way of knowing how long the annuitant will live, and because the contract is created for the benefit of the annuitant, a pure life option provides the largest possible payment. The insurance company is at greater risk of paying more than the principal value at the time of annuitization, so it pays a larger amount based on the life expectancy of the annuitant. A joint and one-half survivor distribution option means which of the following statements is correct? A. The annuitant receives a full share of the annuity payment and the spouse receives an additional one-half of that. B. The annuitant receives a full share of the annuity payment each month, and the beneficiary receives a one-half share of the payment. C. There are two annuitants named in the policy and each contributes one-half of the monthly premium or the lump sum that establishes the annuity. D. Answer. When one of the joint annuitants dies, the survivor's continuing payments will be one-half of the total payment both were receiving. Definition. A joint and one-half survivor annuity pays half of the total payment two or more annuitants were receiving when the contract was first annuitized. Payments continue until the last surviving annuitant has died. What is fixed in a fixed annuity? A. The annuitant. B. The beneficiary. C. The investment option in the separate account. D. Answer. The interest crediting rate. Definition. The fixed portion of a fixed annuity is the interest crediting rate, which may change at the discretion of the insurance company, but not less than the guaranteed minimum. A fixed annuity also promises a fixed payment to the annuitant when the contract is annuitized. What must an insurance producer have in order to market variable annuities? A. A good business reputation and no convictions listed in 18 U.S.C. 1033, the Federal Violent Crime Control and Law Enforcement Act. B. A variable contracts insurance agent license issued by their resident state's regulator. C. A copy of the current prospectus to give to a customer prior to or at the time of the first appointment. D. Answer. A securities license as a variable contracts and investment company representative in addition to a life agent license. Definition. A licensed life agent also needs a securities license to be able to transact variable life or annuity contracts. Each of the other answer choices is an accurate statement, but does not answer the question appropriately. What is different about a corporate-owned non-qualified annuity compared to an individually owned non-qualified annuity? A. It earns a rate of interest limited by the IRC. B. Interest or gains are taxable as capital gains, not ordinary income. C. It does not provide a death benefit guarantee of principal to the beneficiary. D. Answer. Interest or gains are taxable as income in the year earned. Definition. Corporate-owned annuities must be associated with a qualified retirement plan for the corporation to avoid current income taxation. There are no interest rate limitations for annuities in the IRC. All annuities provide a death benefit guarantee prior to annuitization. A corporate owner of an annuity will name itself as the beneficiary. End of chapter QA. W and Y are annuitants of an annuity. W dies and Y receives one-half of the amount coming into their household when both were alive. They must have elected which of the following settlement options? A. Life with period certain. B. Joint life. C. Life with installment refund. D. Answer. Joint and one-half survivor. Definition. In a joint and survivor annuity, benefits are payable to two annuitants while both are living. Upon the death of the first annuitant, survivor benefits continue, either paying the full amount or reduced to 2/3 or one-half for the survivor's income until the survivor dies. G is concerned about the future and living a comfortable retirement. Which of the products listed below is ideally suited to help G prepare for their retirement goal? A. A variable whole life insurance policy. B. A U.S. savings bond. C. A bank certificate of deposit. D. Answer. An annuity. Definition. An annuity is designed to provide a steady stream of income to an individual, typically upon retirement. It protects against outliving one's retirement income by providing an income for life. Instead of waiting to receive her payments over time, Jean decides to obtain the greatest amount of money out of her annuity immediately. Which option did she choose? A. Straight life option, life income. B. Life income with refund. C. Life income period certain. D. Answer. Lump sum. Definition. The annuity policy owner is not required to elect a settlement option. Instead, they have the right to surrender the policy just like a cash value life insurance policy to receive the policy's cash surrender value. Which product, offered by insurers, is specifically designed to allow an individual's savings to be distributed to him, her periodically over her entire life, regardless of how long she lives. A. Participating whole life. B. Variable life insurance. C. Universal life insurance. D. Answer. Annuities. Definition. Annuities are the only products in this list of choices that provide lifetime income to the policy owner as stated in the question. If interest rates have fallen since a market value adjustment annuity, MVA, was purchased, what impact will this have on the annuity? A. There would be no impact whatsoever. B. The owner will be required to surrender the annuity. C. The annuity would lose some of its tax deferral benefit in proportion to the dollar amount of the adjustment. D. Answer. In effect, the account values would have increased. Definition. If a market value adjustment annuity is crediting interest at rates that are higher than those available in the open market, then upon surrender, the insurer will add money to the account. In effect, sharing some of the gain it is realizing on its general account bond portfolio. An individual owns a variable annuity. Upon annuitization, the number of annuity units on which the benefit amount is based will, from month to month, A. Decrease. B. Increase. C. Vary. D. Answer. Remain the same. Definition. It is important that the individual understand that upon annuitization, the number of units used to calculate the benefit amount will always be the same. It will be the unit value that fluctuates according to the performance of the separate accounts. The insurer generally assumes the investment risk in all of the following annuities, except A. Market value adjustment. B. Fixed. C. Equity indexed. D. Answer. Variable. Definition. The insurer's general account assets guarantee fixed dollar annuity contracts, and the insurer bears any investment risk. An annuity policy owner has all of the following rights, except A. Elect or cancel any riders. B. Name a beneficiary. C. Select a settlement option to use. D. Answer. Determine the mortality table to use. Definition. The owner has all of the contractual rights in the policy, but choosing the mortality table is not one of them. The insurer does that. Jill wants to know how much to put into her annuity in order to receive the greatest benefit payment amount. Which of the following will provide her with the largest monthly income regardless of the settlement option selected? A. 250,000. B. $750,000. C. $500,000. D. Answer. $1 million. Definition. All other factors being equal, the larger the premium deposit, the larger the benefit payment. Susan, age 65, inherits a substantial sum of money and wants to have the money distributed to her over the rest of her life starting next month. Which product offered by the life insurance industry will allow her to accomplish her objective? A. Single premium deferred annuity. B. Flexible premium deferred annuity. C. Flexible premium immediate annuity. D. Answer. Single premium immediate annuity. Definition. A single premium immediate annuity involves payment of a single sum to the insurer with periodic payments commencing within 1 year of deposit of the sum. Hashtag Chapter 6. Markets and Social Security. Inside Chapter QA. In a group life insurance plan, the employee has control over which of the following? A. Choice of insurance company. B. Mode of premium payments. C. Type of policy. D. Answer. Choice of beneficiary. Definition. In group life insurance, the sponsor of the plan, the employer, has control over all facets of the coverage and cost, but the choice of beneficiary is left to the participant, the employee. A group life plan may not benefit the sponsor of the plan. The master policy for a group life plan goes to the employer. What does a participating employee receive? A. Copy of the master policy. B. Change of beneficiary form. C. Claim form package. D. Answer. Certificate of insurance. Definition. The employees in a group life plan receive a certificate of insurance that describes the benefit, identifies the insurance company and policy and certificate numbers, and provides information about changing beneficiaries or filing a claim. Which of the following is a characteristic of a contributory plan? A. Part-time employees must be eligible to participate. B. Employers must enroll 100% of eligible employees. C. Dependents of eligible employees must pay 75% of the premium. D. Answer. Eligible employees pay a portion of the premium. Definition. In a contributory group insurance plan, eligible employees pay a portion of the premium. Part-time employees are usually not eligible. Dependents of an eligible employee do pay a required percentage of premium. The amount varies as determined by the employer. A contributory plan requires at least 75% participation of eligible employees. Non-contributory group plans require 100% participation. In a credit life plan, who is the beneficiary? A. The husband of the insured. B. The wife of the insured. C. The children of the insured. D. Answer. The creditor. Definition. Credit life insurance is a group form of life insurance that is owned by and benefits only the creditor in the event of the death of the borrower. It may be issued as an indeterminate amount of coverage, as for a credit card, or it may be a single premium type of coverage in the form of decreasing term for a short-term debt, such as an automobile loan. Industrial life insurance is typically sold in face amounts of A. Up to $50,000. B. $10,000 to $20,000. C. $5,000 multiples. D. Answer. $1,000 or less. Definition. Industrial insurance is typically marketed to low-income persons. Face amounts are available in $1,000 increments or less. Some states limit the amount of coverage on any one life to no more than $10,000. Premiums are most often paid in cash to an agent on a weekly or monthly basis. A buy-sell agreement. A. Specifies the conditions and requirements that are necessary to sell the business to a third party if a business owner dies unexpectedly. B. Provides the business with funds in the event of the death of a key person who is not an owner. C. Describes which relatives of a business owner have the right to purchase that person's interest in the business. D. Answer. Assures the continuation of the business by providing benefits to the surviving business partners to buy out a business partner's interest in the event one of them dies unexpectedly. Definition. A buy-sell agreement is funded with life insurance and is designed to protect the business and assure continuation by providing benefits to the surviving business partners to buy out the deceased partner's share of the business. A primary purpose of key person life insurance is to A. Provide the business with money to pay vested retirement benefits to the heirs of the employee as a lump sum. B. Protect the business against the death of any employee earning at least $50,000 per year. C. Provide the family of the deceased employee with up to 10 years of the employee's lost future income. D. Answer. Provide the business with money to recruit and train a replacement employee. Definition. A valuable employee with highly specialized knowledge or skills, or who adds significant value to the revenue/profitability of the company is a key person, and wages alone is not a criterion. The death of such a person can negatively impact the business operations. The company may use the death benefit proceeds for any purpose, but one of the most common uses is to cover the expense of recruiting, hiring, and training a replacement, which may take months to accomplish. In order for a worker to be qualified for all of the benefits available from Social Security, how many credits must be earned? A. 30 credits. B. 1 credit for each year of work between age 20 and age 40. C. 6 credits in the last 13 quarters. D. Answer. 40 credits. Definition. To be eligible for SS all benefits and be considered fully insured, a worker must have earned 40 credits. End of chapter QA. Social Security retirement benefits are available as early as age, but are less than if paid at the full retirement age. A 65. B. 67. C. 70. D. Answer. $62,000 multiples. Definition. Social Security retirement benefits start as early as age 62, but at a reduced amount. The 31 days in which the employee may change her group policy to an individual policy upon termination and without evidence of insurability is known as A. The contestable period. B. Change of policy provision. C. Ownership rights provision. D. Answer. The conversion period. Definition. As the name implies, the conversion period is the period in which an employee may convert the group term death benefit to an individual permanent policy upon termination and without evidence of insurability. With a non-contributory group life plan, what percentage of the employer's employees must participate? A. 75%. B. 90%. C. 50%. D. Answer. 100%. Definition. A non-contributory group life plan is one in which the participant does not pay premiums. State law requires that 100% of eligible employees are covered. The insurer can be certain that all employees will enroll, and it will not be subject to adverse selection. Buy-sell agreements are used for all of the following entities except A. Closely held businesses. B. Partnerships. C. Sole proprietorships. D. Answer. Large public corporations. Definition. Large corporations are not candidates for buy-sell agreements. The buy-sell agreement is for much smaller entities. Under a business entity plan where life insurance policies are purchased, the business is all of the following except A. Premium payer. B. Policyholder. C. Beneficiary. D. Answer. Insured. Definition. Under an entity purchase plan form of a buy-sell agreement, the business is the owner, premium payer, and beneficiary of a policy written upon each of the partners or shareholders who are the insureds. The Social Security death benefit is payable to the A. Named beneficiary. B. Estate of the insured. C. Next of kin. D. Answer. Surviving spouse. Definition. The Social Security death benefit is payable to the surviving spouse or minor children if they meet certain requirements. What is the minimum requirement for currently insured status under the Social Security system? A. Earned more than minimum wage. B. Have 40 quarters of covered employment. C. D. Have not had a previous Social Security claim. D. Answer. At least 6 credits earned in the 13 calendar quarters prior to death or disability. Definition. A worker must be covered at least 6 quarters during the full 13-quarter period ending with the quarter in which the worker dies or becomes disabled. Which of the following best describes third-party ownership in life insurance? A. A business partner buying a life insurance policy on him/herself. B. A key employee buying a life insurance policy on him/herself. C. A policy owned by the insured. D. Answer. A policy owned by one person insuring the life of another person. Definition. When a policy is owned by someone other than the insured, it is a third-party ownership situation. All of the following regarding credit life are true except A. It can be either in the form of individual or group coverage. B. The coverage is on the life of the debtor. C. The form of coverage is normally decreasing term insurance. D. Answer. Usually the creditor pays the premium. Definition. Usually the individual debtor pays the premium. Proceeds from a buy-sell agreement are received. A. Taxed to the extent that the amount exceeds $50,000. B. Taxable as income. C. Only after the deceased estate is settled and a proper valuation of their share of the business. D. Answer. Income tax-free. Definition. The premiums payable for a buy-sell agreement are not tax-deductible, therefore the benefit is received income tax-free. Hashtag Chapter 7. Federal tax considerations and retirement plans. Inside Chapter QA. To be considered terminally ill and qualify for accelerated death benefits tax-free, federal law defines a terminal illness as one that is expected to result in the person's death within how many months? B. 12. C. 36. D. Answer. 24. Definition. Federal law establishes 24 months as a person's maximum life expectancy to be defined as terminally ill. Which of the following distributions in a life insurance policy is taxable? A. Policy loans. B. Withdrawal of cost basis. C. Cash dividend from a participating policy. D. Answer. Interest paid on a death benefit settlement option. Definition. Policy loans, cash dividends, and withdrawal of cost basis are not subject to taxation. Interest paid as part of a death benefit settlement option is taxed as ordinary income. When may an employer deduct the premiums it pays for an employee's life insurance benefit? A. If the business does not receive more than 50% of the death benefit. B. Employers can always deduct the premiums it pays for an employee's life insurance benefit. C. An employer cannot ever deduct premiums it pays for an employee's life insurance benefit. D. Answer. As long as the business does not derive a direct benefit from the policy. Definition. As long as the insurance death benefit is not payable to the employer when an employee dies, the premiums paid for the life insurance are deductible to the business. All of the following statements regarding a modified endowment contract are correct, except A. Premature MEC distributions on gains are subject to a 10% penalty in addition to taxation. B. Distributions received from a MEC are subject to a LIFO tax treatment. C. A policy that fails the 7-pay test will be deemed a MEC. D. Answer. A MEC status can be removed from a policy if excess premiums are refunded. Definition. A policy that does not pass the 7-pay test will be deemed a modified endowment contract for the contract's life. All of the following tax-free exchanges of life insurance and annuities are permitted, except A. Life insurance to an annuity. B. Life insurance to long-term care insurance. C. Annuity to long-term care insurance. D. Answer. Annuity to life insurance. Definition. Annuities may not be exchanged for life insurance. All of the following are characteristics of a qualified retirement plan except employer contributions are immediately tax deductible to the employer. B. The penalty for premature distributions may be waived for first-time homebuyers. C. Employee contributions are either pre-tax or tax deductible. D. Answer. Employers in private industry are required to establish pension plans. Definition. ERISA is a federal law that sets minimum standards for employers who establish pension plans in private industry, but does not require employers to establish a plan. A Roth IRA is unique for which of the following reasons? Contributions are non-deductible and distributions are taxable. B. Contributions are tax-deductible and distributions are taxable. C. Contributions are tax-deductible and distributions are tax-free. D. Answer. Contributions are non-deductible and distributions are tax-free. Definition. Roth retirement plans are funded with after-tax, non-deductible money. Under current tax law, distributions are received tax-free, including all gains. A tax-sheltered annuity may be established and funded by which of the following? A. XYZ's Catering, a small unincorporated business. B. Johnson Accountants Incorporated. C. A professional law firm. D. Answer. A not-for-profit community hospital association. Definition. 403(b) plans are established for nonprofit organizations. What is defined in a defined contribution plan? Ed. The percentage or amount of an employee's distributions from the plan. B. The percentage of the employee's income provided as life insurance to the employee. C. The employer's percentage or amount of distribution to an employee from the plan. D. Answer. The percentage or amount of an employee's deposits to the plan. Definition. In a defined contribution plan, the employee chooses how much of their pay to contribute to the plan each payroll period. The employer deducts that amount from the employee's pay before income tax is calculated and remits that amount to the plan's custodian for the benefit of the employee. End of chapter QA. If the annuitant dies during the annuity phase, the remaining value in the account will be A. Added to the original owner's estate for valuation, if the owner is different from the annuitant. B. Added as 100% taxable income to the recipient. C. Added to the beneficiary's estate for immediate estate taxation. D. Answer. Added to the deceased annuitant's estate for valuation. Definition. If the annuitant dies during the annuity period, the payout or liquidation phase, the remaining value in the account will be added to the deceased annuitant's estate for valuation. However, this does not apply if the pure life option was selected, as the remaining balance is forfeited to the insurer. A life insurance 1035 exchange can only be completed after A. All surrender charges have disappeared. B. The policy has been declared a MEC. C. Policy conversion has taken place. D. Answer. Has been declared a MEC. Proof of insurability has been provided and accepted. Definition. Life insurance 1035 exchange requires that the insured prove insurability in order to obtain new life insurance as part of the transaction. If an accelerated death benefit is in effect, how often must the insurer provide a report showing the amount paid and the amount of the remaining benefit? A. Quarterly. B. Annually. C. Semi-annually. D. Answer. Monthly. Definition. Insurer is required to provide the report monthly. When an annuitant annuitizes their annuity that has a cost basis in it, the amount of the income benefit payment subject to tax is determined by using the A. Exception rule. B. Annuity rule. C. Superannuation ratio. D. Answer. Exclusion ratio. Definition. The exclusion ratio allows the annuitant to account for the cost basis over time so that the initial payments are not 100% taxable until all cost basis has been fully accounted for. P is the owner of a life insurance policy. P accidentally pays premiums in excess of MEC guidelines. To avoid being classified as a modified endowment contract, the insurer may refund the excess premiums paid within how many days after the end of the contract year? A. 45 days. B. 10 days. C. 30 days. D. Answer. 60 days. Definition. Excess premium can be refunded by the insurer within 60 days after the end of the contract year. G. Being undecided on what to do with the $100,000 just received on F's life insurance policy, decides to leave the proceeds on deposit with the insurer at interest. The rate being paid is 5%. In 1 year, what amount will be taxable to G? A. 10,000. B. 0. C. $500. D. Answer. $5,000. Definition. G has opted for a settlement option, which allows the death benefit to incur interest. That interest is taxable as ordinary income, while the principal, $100,000, is tax-free. All employer-paid premiums for amounts above $1 of group life insurance are reported as taxable income to the employee. A. 75,000. C. $25,000. D. Answer. $100,000. Definition. All employer-paid premiums for amounts above $50,000 are reported as taxable income to the employee. If no beneficiary is living at the time of the insured's death, the benefit will automatically be paid. A. To the funeral home. B. To the deceased spouse. C. To next of kin. D. Answer. Into the insured's estate. Definition. If no beneficiary is living at the time of the insured's death, the benefit will automatically be paid into the insured's estate. The policy owner could also choose to name the estate as a beneficiary. All of the following regarding employer group life insurance are true, except A. Employer-paid premiums are taxable income to the employee when the death benefit exceeds $50,000. B. Death benefit proceeds paid to an employee's named beneficiary are received income tax-free. C. Premiums paid by an employer are tax-deductible to the business as an ordinary and necessary business expense. D. Answer. Employee-paid premiums are tax-deductible to the employee. Definition. Premiums paid by an employee are not eligible for a tax deduction. What are the tax ramifications when a corporation owns an annuity contract? A. Withdrawals are taxed, but at the favorable corporate rate. B. There is no tax penalty for early withdrawal. C. The premiums are tax deductible as a business expense. D. Answer. There is no tax benefit. Definition. Because a corporation is a non-natural person, a corporate-owned annuity is not treated as an annuity for tax purposes. There is no tax benefit or deferral. Instead, earnings are taxed every year. Hashtag Chapter 8, Michigan Stay Laws. Inside Chapter QA. Which of the following tasks require a producer's license? A. Providing technical advice and assistance to licensed insurance producers. B. Inspecting the training of insurance producers. C. Settling a claim on a contract of insurance. D. Answer. Soliciting insurance. Definition. An insurance producer is a person required to be licensed under Michigan law to sell, solicit, or negotiate insurance. Which of the following is not a prerequisite to apply for a producer's license in Michigan? A. Completion of the pre-licensing course. B. Passage of the licensing exam. C. Being at least 18 years old. D. Answer. Having a high school diploma. Definition. There is no requirement for an applicant to possess a diploma or degree. All of the following would be eligible to have their pre-licensing requirements waived by the director except an applicant who A. Has a bachelor's degree with a concentration in insurance from an approved institution. B. Has obtained the CPCU designation. C. Applies for a credit insurance producer's license. D. Answer. Has been a licensed insurance producer within the preceding 36 months. Definition. The director may waive the exam or pre-licensing requirements for an applicant who applies for a limited license, has been a licensed insurance producer within the preceding 12 months, has obtained the CPCU, CLU, CIC or other professional designations, or has an associate's, bachelor's, or master's degree with a concentration in insurance from an approved institution. Within how many days must a producer notify the director of a change of address? A. 40. B. 20. C. 10. D. Answer. 30. Definition. Licensees must notify the director of any change in mailing or electronic mail address within 30 days after the change. How many credit hours of continuing education must a producer complete to maintain their license during each renewal period? A. 12. B. 48. C. 36. D. Answer.